So thank you all for being here, and thank you, Anthony, for curating another amazing year of SALT. I have an awesome panel. Everybody brings something different to the table, so I'm really excited. This panel is about how to find opportunities in this very mature bull market. But I'm with CNN, so I'm going to start with the news. And as my colleague says, what's happening right now? Right now, the U.S. is negotiating a trade deal with China. And the president has said, he's actually filed, the administration has filed paperwork to put to raise tariffs on $200 billion worth of Chinese goods, going from 10% to 25%. First off, there's been a lot of predictions on whether or not it's actually going to happen. Jeff, your boss, has given the probability about a 50% chance that the administration goes through with this. Care to disagree?
How about 51? Taking a big leap. I mean, look, 50 says you don't know, right? No one knows. But if you've followed Mr. Trump for the last couple decades, he likes tariffs. He thinks they're a good idea. And it kind of looks like he wants to do it. So I'm going with 51%. Yeah, I think he has a good chance of doing it tomorrow. He can always pull it back, right? So start it off. He doesn't think it impacted anything. People disagree with it who are consumers or actually selling the goods and seeing the input costs go up. But it's obviously not a positive thing in the short term, but we'll have to see.
For the most part, the current tariffs haven't had a very big impact on the economy broadly here in the U.S., but there is a threat. He's threatening to put tariffs on an additional $325 billion worth of goods. A lot of those are consumer goods. Jane, does this escalation, if it happens, does that mean that we could see a broader economic impact than we've seen so far?
You don't know what sets off things, but when you look at the economy right now, at least from our eyes, it looks relatively stable, but we plan for both cases.
How do you deal with the historic level of sort of unpredictability from DC, whether it's political or policy oriented right now? I mean, do you guys have certain things that you're doing differently, approaches that you're taking now that you have this sort of unpredictable pattern that we've seen?
I mean, I think in our case, we've tried to stay a little bit more on the defensive side, expecting that we were going to see, I'll call it policy risk coming out of the White House. What is the next, tweet going to do? I'm not particularly surprised by the tweet over the weekend. Equity prices were back up at almost all-time highs after the sell-off in the fourth quarter. You were priced at levels that you were very vulnerable to a sell-off, and this was the catalyst for it. And I suspect, there wasn't a lot of negative impact last time. He went through this. Markets came right back. He's probably thinking it's a good negotiating strategy.
Bloomberg had this story recently about the amount of cash that's on the sidelines, and I'm just curious to get your thoughts on it. The story said that the world's rich had put a third of their funds into cash as the trade war, as the uncertainty is kind of out there. What's your sense of the amount of cash that's actually on the sidelines right now?
Look, I think from our perspective, when I look at our client base has been nervous in terms of the environment. But clearly, if you take a step back from day-to-day noise, we have been in this bull market almost 11 years. And in July, it's going to be the longest extension ever in the history of the US market. So the reality is we all enjoyed, everybody in this panel, everybody in this room, in an environment that has been lower than normal volatility and higher than normal return, right? And so we expect in an environment going forward that returns are going to be more compressed and the volatility is going to pick up. And I think that's this adjustment is what's going on right now. That's why it's late stage. And late stage market also, this is part of the cycle where we all make money nervously because there's a lot of risk of FOMO, which is the fear of missing out. So this is why there's a lot of nervousness, a lot of uncomfortable in the marketplace. But the reality, this is how we are going to adjust to go to the next stage in the market.
And remember, cash yields something today. That's
What's that?
Cash yields something today. We're not in a zero environment anymore. And so when 12-month T-bills yield more than 2s and 3s on the Treasury curve, I mean, there's a good reason to own it, right? You're liquid. You're in the most liquid market out there. We're printing a lot of T-bills, by the way. So there's more liquidity coming. And so it's not shocking to see people want to own money market funds, short-term Treasuries. It makes a lot of sense.
Yeah, I also think you're in this world of still post-financial stress syndrome is what I call it. And you know, it may be 10 years ago that the financial crisis hit, but I talk to investors and they think it was yesterday and they're still behaving and reacting like it was yesterday. So I'm not surprised they have cash. And I think Jeffrey's point is spot on. You know, people were grabbing for yield all of a sudden at 2.25, 2.3 in a T-bill. I might as well sit in 3-month bills, let them roll and be safe.
Yeah, like back in July of 16, the 30-year bond didn't yield as much as T-bills do today. So that's a case in point.
Alper, I'm glad that you brought up volatility because volatility has been generally low, but when it comes, it seems like it's a lot harder and faster than before. So when we have these moves, they're big. I've been on the floor and they're big and they're fast. Is there a way to capitalize on that volatility when it does hit, or is it just too fast?
Sure, it's a good question. And based on our research, look, it's really hard to time the volatility. To your point, when I look at the, VIX is one measure of volatility for equity markets, so we look at the move, which is for fixed income. It's really hard to time and to really have a good entry point to identify the opportunity. So from our perspective, the best way to really prepare for volatility, having the right asset allocation in your portfolio. And the time is now. You have to prepare your portfolio before the storm, before things change. And we have been in this environment that, look, last 10 years, if you think about it, the asset allocation was a cost. If you invested in the simplest ETF tracking S&P 500, you outperform 99% of the investors' global basis. So it has been easier. And now we have to think about what it means for equities, fixed income, and alternative investments, which is probably one of the only pockets can help us to diversify the risk and help with volatility.
Jane, you don't think there's a way to play it, right?
I mean, I agree with you, Alper, on the big picture. But on the manager level, what it seems to me is that people have had to dust off their risk management playbooks.
Yep.
What was risk management before? Oh, go sit outside in the sun or do whatever. The market goes up, you don't worry about it. And now that they're using their risk management playbooks, you're seeing real big changes in the market. For example, you're seeing derivatives trading much more volume than the cash market, than the normal relationships. And I think this is one of the issues that unless you adjust for this is creating a lot of havoc with quantitative managers because the market's changing underneath.
How much time do you guys really spend thinking about what Trump is going to tweet next?
0.
Really?
It doesn't matter. I mean, like you have Congress that drives fiscal
policy. The market
policy.
does move on that.
Well, it does, but it's exogenous. It's like saying that you have a Russian missile in the air right now. It's exogenous. You shouldn't worry about it too much. How do you hedge that? Exactly. I'm not really sure about that. So I can't hedge Trump. I can't predict Trump. So I don't worry about it. Look, it's good. Things move markets that you can't control, and you have to just get used to it. We're 2 years into the administration, and look, I haven't been able to predict one thing out of his mouth. And that's why I have this heavy, strong conviction at 51% tomorrow. I'm taking a stand.
Look, I don't think you can predict what's going to come. I think what you know is that something else is going to come. There's always going to be another tweet, and you can try to position your portfolio so that you're somewhat, immune to that. So maybe you don't want to own equities when they're at all-time highs and PEs are at top levels because when you get a negative tweet, they're going to go down, and maybe you buy into that. But I don't think you can plan on it. I don't think you can put a specific trade on it. I think to Alper's point, you can allocate your portfolio to certain sectors that might not be impacted as much, so it kind of smooths out your return overall and lets you sleep at night a little bit better. But that's about it.
Now, the president has directed a ton of tweets and spent a lot of time attacking the Federal Reserve, and to the point where it's sort of become a joke at this point. But I guess my question is there any danger to the economy to attack an institution, to attack the Fed? Do you think there's any negative potential consequences from that, but undermining the Fed?
Yeah, I'll take that one. I think that if you take a look at it, I think Mr. Powell's scared. He's scared of Mr. Trump because the market's either going to go down or he's going to get attacked, right? And so, Mr. Powell should turn around and say, hey, President Trump, look, you tanked the market this week, not me. But maybe Trump is actually trying to tank the market so he can get his 100 basis point rate cut. Look, the market's listening for some reason that the bond market started to listen to the president and really start to price in cuts this year. Just because the Fed stopped hiking doesn't mean that the next move has to be a cut. It's happened when they've paused before and actually took a hike. But again, it is kind of strange to see, attack an institution that's supposed to be sacred, it's supposed to be independent. The Fed's never been independent.
No, I get you on that point, but my question is more about, is there a risk to economic growth when you undermine an institution like the Fed? You don't think so. But why is the market listening to Trump? Why is the bond market pricing in a cut when we have all-time low unemployment?
I don't know if it's necessarily listening to Trump.
Or 50-year low unemployment, good growth at 3.2%.
Right. I think the market's listening to Draghi and the Fed. And so what we had is a dichotomy that changed last year where the ECB became even more dovish than they historically had been, and Draghi is the king of the doves, right? So it's been this dynamic where you've had Draghi to say, look, we can't do anything. We have to keep status quo. We're probably going to have to cut rates again. We need these new facilities. And Powell bought into it too. But I think what's changed with Powell, and I don't think it's the president, I think he's been taken over by the Bernanke and Yellen rhetoric, and he's now talking like an academic. He dusted off the R stars and all these quantitative models back in September press conference. Then he said we're on automatic pilot. I'm just not even going to care. The model says we should keep going, and all of a sudden the market tanked. And what you had beyond that is then you had the kumbaya the first week of January where he met with Yellen and Bernanke. They told him, young Padawan, this is the way you have to do it. And he listened, and he's become essentially an extension of that. He's not the pragmatist. He's not the business person that people thought he was. And look, it took him a year to learn the job. Did you learn your job in the first year? In the first few months? It probably took a little bit of time. So now he's back in status quo, and I think that's what the bond market's looking at, is that we now have a true dove because he's got these two former chair people in his ear.
I also think he was looking at what's going on in Europe. There really is a slowdown going on in Europe. I think he's partly reacting to that. That happened to come at the end of last year when you had the last time that the whole trade discussion, highlighted. You had markets coming down almost 20%. He panicked in front of that. And then I also think they're dealing with a tool that they've never had before, which is the size of the balance sheet and the unwind and what is the impact of that and how far do you go? And the markets are trying to grapple with that. And we've never seen that before. And so I think hitting the pause button there is pretty good. The economy is in good shape right now. Yes, growth has slowed. We're not at 3.2, 3.3. Maybe we're at 2.5. That's still pretty good. And yet we don't have any inflation pressure. So, what's wrong with taking a pause, sitting back, seeing how things go, and try to let some of this noise die down?
Yeah. And also, one other perspective, I agree with what Ray said. And if you listen to what Powell said in January 4th, right? He said that they're going to be incredibly dependent on the data. They're going to watch the data, and they're going to pause. They're not going to stop. And I think the challenge with that is the data, the economic data, is not as clean as you would like to see. Like the data is very volatile, and the data has different interpretations.
Well, the data is never clean, right? There's never one direction for the data, right?
That's why
there's always going to be conflicting.
You can torture the data to get it to say whatever you want.
Trust me. Right. That's the old quant saying, right? But look, Yellen also came out at one point and said GDP is a noisy indicator.
Mm-hmm.
Yeah. So you can say anything you want about the data set, and your point is valid, the pause. But pause is fine, but the bond market started pricing the cut. And I think that the difference is that they think he's been indoctrinated into this way of thinking of that, look, we're stuck here. The balance sheet, we are stuck. We're going to be stuck here. The balance sheet's going to grow probably before the next recession. They're even talking about quantitative easing coming back as a standard policy tool, right? That's also on the back of having MMT, where we don't think deficits matter anymore. We're going into unprecedented territory here. And the bond market thinks it's a bit under control. But we have noticed is, if you look at the shape of the 530 curve, right, which 5 is kind of the economy, 30 is long term, it's been steepening really for the last 6 to 8 months. And we think that the market is getting the perception that there is something wrong with the fiscal deficits, but we'll have to see. I mean, it's way too early to tell. And it's not like it's going to blow up because we do a $2 trillion deficit next year.
Yeah, I've actually been pretty surprised to your point, just how immune the market's been to the size of the deficit. And this just kind of been cranking along this year at like a super high rate, and it's big shrug.
Yeah, I know I'm shrugging right now, but I mean, look, we're obviously concerned about it.
I feel like you're always shrugging. But Jane, have you found a way to sort of isolate the risk of the market going the market maybe not getting the cuts that it wants?
I mean, I worry about that. So one of the things there's two types of risks. There's the risk of the market going up and down, and then there's the risk of the market doing crazy things internally. And what's really interesting is we had a lot of volatility in December, so crazy ups and downs. But a lot of managers, particularly on a hedge basis, did really well in December, were positive, because the market's internal structure was really solid. So you have to make a difference between the two of them, depending on how much hedging you do. So the way we think about it is the amplified noise that comes from all sorts of crazy places, we can't do anything about that. But as long as things move in a relative structure, if it goes up or down, you can hedge against it.
And in terms of Powell's position to communicate more to the market, I think he increased the guidance 8 times a year from 4 times a year.
I bet he regrets that today.
Totally.
Is that a good thing for?
Well, I mean, if you're going to use forward guidance as a policy tool, yes, and that's what I'm saying. He's learned from Draghi. Is that Draghi's the master of talking a market in a direction with inactivity as well. And so, look, there's nothing wrong with signaling the Fed's thinking. I think that's a good thing for investors. The problem is that we've been so entrenched in hanging on every single word that we think every single word is so important. And look, he's a disaster at most of his press conferences. He wants out of there. You saw it the last time. It's the shortest press conference he's done to date. He said, look, I just don't want to screw up the market, and dang, I did. I got to get out of here. And look, that's the problem with talking too much when you are the focal point.
Well, that's what I'm getting at. Like, is there a danger in talking too much?
Well, people hang on every word, and that's why I think bond traders turned around and said, look, I think there's going to be a cut. You got roughly a 60% chance of a cut by December. That can change if the 2-year goes up 15 basis points, so it can get pretty flat. But I think that people have been lulled in that side. I'm just shocked. If you'd have told me that economic data would have rebounded from the fourth quarter, albeit softer, Europe is not as catastrophic as you see, and you're starting to see a little signs of life there. Again, I'm not uber bullish there, but you tell me that, you tell me the stock market sets a new high once again, you tell me credit spreads are tighter than they were in the fourth quarter of last year, EMD spreads much tighter, and then you tell me rates are 70 basis points lower. I just said that doesn't make sense. So something's wrong. Typically, I side with the rates market in those things. I just don't really feel that way right now. Looking at the economic data, I just think rates should be a bit higher. But I mean, look, 30, 40 basis points, who cares, right? But it does matter to a fixed income manager. It matters to your duration of your portfolio. And I'm just not a big fan of buying duration today.
So what's wrong? So
well, that's why I say I think something has been read into the Fed that there's going to be a massive cut coming. We were talking about an insurance rate cut. Has anybody ever heard of this in their careers? I mean, the Fed doesn't do insurance cuts. There's, PCE missed. Well, PCE's only achieved that 2% number like 2 months since the financial crisis. So yeah, it misses. That's what it does. Okay, it was a little disappointing, but it's still 1.4, 1.5 on core PCE. The healthcare costs are understated in there. CPI, core CPI is almost 2. What gives here? And so maybe we're reading way too much into this inflation data, and all of a sudden that the Fed's going to respond. They respond when it's 50 basis points. They don't respond at 1.5.
And the reality, look, let's go to your point. Let's go to basics. The Fed's primary mandate, dual mandate, right? The employment and also the inflation. And the economy is you're in the maximum employment. And we see the inflation pressure building up. You look at the labor market, the wage costs. You look at if you believe that the U.S. dollar is peaking, as well as the commodity prices, especially the energy and the food prices. You will expect that that if they stick to their mandate, that's going to mean something, and that direction is, I think, that a little bit more clear. You think that from that perspective.
But you also have a lot of underemployment. So I do think there's more give in the system than people are estimating.
Yeah, well, I mean, what, U6 is still like 7%, right, when you count the underemployed. So it's a fair point. I mean, who knows what maximum employment is? That's why get rid of NARU, get rid of R-Star, all these things that they talk about. And we thought he was going to do that until he didn't.
So I'm going to take a hard turn here because I don't think you can talk about investing in this particular market without talking about the social and cultural pressures that companies are facing. Just today, Facebook's co-founder, Chris Hughes, called for the company to be broken up. And in this op-ed, Hughes wrote that Mark Zuckerberg is a good, kind person, but I'm angry that his focus on growth led him to sacrifice security and civility for clicks. First off, do you agree? And has the increased scrutiny and regulation been priced into these stocks fully?
I'm going to let someone jump on
I guess
that one.
I'll take a kind of a first stab at that. No, I don't think a breakup of these companies have been priced into the stocks. I think that the discussion around...
Well, first, do you think that they should be broken up?
I don't have a strong opinion. I think probably not. I do think it's a larger societal issue if you want to talk about the impact of, I'll call it, the tweeting world, or how mean people can be to each other if they can hide behind, screen names. And I think you see that a lot in the suicide rates going up amongst younger people. I think there's a high correlation to that and social media, and whether that's Facebook or Twitter. And so I think there are issues we have to deal with as a society for that. But I don't think the solution is you break up the companies, because the mechanism and the tools are still going to be there, and they'll just grow somewhere else. I think there's a bigger education that one needs to go through to solve those issues.
And you don't think that the possibility that they're going to be, regulated, because there has been so much talk about regulating Facebook and...
Look, the regulation may come because the politicians decide they don't like these tools being used to impact their elections and their ability to get reelected. So I think that's a self-serving nature of the politicians that will talk about breakup. I think there's other issues we need to deal with that are bigger than that, though.
Is that something that you confront in big, when you look at managers who specialize in technology or in clients who want to buy into these big tech names? I mean, is that something that they're talking about in terms of risk?
No, not really. It's not something that we do.
Jane, do you have any thoughts on this?
I mean, you've got these businesses with massively increasing returns to scale. They get more powerful as they get bigger. We were in a similar situation about 120 years ago, and eventually the world changed. I think it's not going to continue on this way. Something will interfere, probably of some sort of regulatory environment, but I don't think it's anything on the short horizon.
Similarly, companies have been getting a lot of scrutiny because there's been a lot of talk about how they're increasing income inequality by taking the tax savings that they earned on the tax cuts and using them to buy back stock, and that is contributing, at least to some of the data show, to income inequality. I mean, is that something that investors are talking about and pricing into any? I mean, Abigail Disney took a huge shot at Bob Iger, saying that he should redistribute some of his bonus to his workers. I mean, are you pricing in the fact that companies might have to pay their workers more? Is that being factored into any of the models that you guys are seeing?
Well, the polarization has to be addressed somehow, right? I mean, we can't continue the directions we're going. And so capital is taking a big share of GDP relative to labor, and it's undeniable. And you look at any data set, it shows you that. And so the question is, how long can it go on? But how does it change? It changes revolt from the bottom. And that's probably why you see the prevalence of MMT, why you see these ideas of like, look, we don't have to worry about the deficit. I'm sympathetic to the argument. If you just go out and as a politician today and you say, look, probably on the left side is the way you do it, you say, well, who benefited from quantitative easing, right? The wealthy got it, tax cuts came to corporate America, the rich got richer. What did you get out of it? This Fed has this balance sheet, it's causing problems by trying to unwind it. Here's an idea. We just spend, when we're done with QT, it'll be about $3.7 trillion. $3 trillion was the increase in the size of it. Why can't we spend that $3 trillion on you, the working class? Why can't I give you healthcare? Why can't I give you free education? You know what? That would sell in a heartbeat, right? Because, well, look, there's no ramification to have a big balance sheet. That's why the things are going in tandem right now. People are focused on the Fed's balance sheet and MMT, and I think it's a natural repository to monetize debt.
As long as there's no pain for free stuff,
That's
people
right.
are going to give away free stuff.
Why not? It's an easy way to get elected. And hey, do you guys want free stuff? You guys are sitting here drinking free water and stuff. I mean, people love it. I mean, we have events. People like clamor for like a free like little tchotchke thing. I mean, people like free stuff. It's awesome. It's better than paying for it. But if you ask them for like 5 cents, no one would want it, right? There's something about that free value. It's like, why don't you do work for free? Because that's the value people place with what that price is.
We only have a few minutes left, and I want to get your thoughts on how likely it is that we'll get a sustained pullback in the S&P before year end. Jane, we'll start with you.
Oh my goodness, I have no clue.
Honesty is the best policy.
Sorry, I can't help myself. I mean, the market goes up and down, and I studied. I was a finance professor for a while, so I taught this stuff. And honest to goodness, I think for the first year or two, I think Keynes said it right. It's animal spirits, and who knows? Over the long haul, it's clearly going to go up because the economy continues growing. I don't think there's any reason you're not going to see the economy continue to grow. But as far as short-term timing, I wouldn't have a clue.
Alper, what about you?
I mean, look, I think Jane said it well. I think, look, in terms of the short term, like it's very random, right? It's really hard to for most people to be able to time that or trade that and really make money out of that. But I think the name of the game is a long term, having the right asset allocation, right investments, and really try to be a little bit contrarian. And I think so there are certain part of the markets right now too much money chasing too few deals, and that should alarm you, and you should think about what that means. Liquidity, something that we haven't talked about, right? I mean, there are certain part of the market since financial crisis, liquidity has not been tested. And especially in fixed income side, where when the regulatory environment shifted and the banks don't have the inventory, and it's a real issue. And you think about it, we never tested. And look at some of the behavior you want in the high yield market, right? In terms of the covenant light and people, the risk behavior is gone. I think you got to think about what that means. And a final point I will say, from my perspective, look, there are a lot of products also out there that you got to think about the liquidity mismatch. What I mean by that, there could be a product that trades or invests in illiquid investments, but they may have a daily liquidity, or they may have a weekly or monthly liquidity. And the reality, we know that everybody rushed the same door. You are going to be part of the crowd, and unfortunately, you may think that I'm not selling my share, but if you are invested in that product and others people are selling, actually you are also part of that crowd. So we got to think more about that. Those are the issues I think really matter, how the cycle is going to turn here.
Ray, what's your prediction there?
Hey, look, go back last year, first quarter, V-shape. Fourth quarter, V-shape. Maybe this week is the start of another one. So I think volatility is going to stick around. I think you get used to it, but as long as the economy is growing at 2 or 3%, markets are going to trend upwards. We didn't really talk about it yet. Another catalyst for market volatility is going to be the elections. They're going to be here right around the corner, and markets going to have to deal with that. To Alper's point on liquidity, I'd argue that liquidity is really not that good in the markets, because if you're taking a market the size of the US equity market and you can move the thing 10, 15, 20% on basically a tweet, that tells me the liquidity is terrible in those markets. So you just have to kind of live through it, position your portfolio with a lot of different risk-taking tools in it, so you smooth out the volatility. And I think Alper talks about that a lot when he talks about asset allocation and owning the right things.
Yeah, V-shaped recovery, V-shaped recovery, V-shaped recovery, vol, except in U.S. rates.
Yep.
That there's something different going on in that market, and like maybe the market's saying we're going into recession. Sure doesn't look like it economically. You keep talking about 2 and 3% real growth. Inflation is existent, right? It does exist. It's more than 1%. It's probably closer to 2. We think it goes like 2.25 this year, right? With headline, right? Given where oil prices are and the like. So we have a 4 to 5 nominal GDP, and we got a let's just say the 10-year sitting at 245.
What do you think the rate market is saying, though? I mean, do you think it's saying that there is some kind of risk out there that's not being?
I think something's wrong. One of these markets is massively wrong. And I said, usually I side with the rates market. I think the rates market is too bearish on everything else. Like, no one here is given a bearish outlook.
Usually you side with the rates market, and you're
usually
not.
When rates deviate from everything else, usually rates come to be the correct market.
And in this instance?
But we haven't had these huge rallies. We only had a rally in the fourth quarter, and we just haven't moved all year, right? I mean, yeah, we're in 15 basis points on the 10-year year to date, roughly. So, I mean, okay, 15 basis points, but markets are up, S&P's up 14 now, 15, I guess it depends on the day. High yields up in the double digits, EMD's up similar. Why haven't rates moved? There's something to rise, so watch it. Maybe you play vol there instead of doing it, in an outright direction, so.
Jane, really quickly, I have one question for you. Why don't we see more hedge fund managers who are women?
I don't know. I'm trying to do something about it.
All right. Thank you so much, guys. We are out of time. Thank you so much.
Yeah, thank you.
Thanks.